$12 billion. That's how much it will cost just to repair homes destroyed by Hurricane Helene in western North Carolina. But here's what nobody's talking about. This disaster didn't just destroy houses, it revealed a housing market that was already on the verge of collapse. And right now, as you watch this video, a perfect storm of climate risk, insurance chaos, and skyrocketing prices is reshaping one of America's fastest-growing real estate markets. Whether you're an investor, thinking about moving to the East Coast, or just care about your money, what's happening in North Carolina right now could be a preview of what's coming to your market. Let's break it down. Welcome back to the channel. I'm diving deep into the North Carolina housing market today, and trust me, this is not your typical real estate analysis. We're going to cover three critical things. First, why Western North Carolina was already in a housing crisis before Helene hit. Second, the real cost of the hurricane, and I'm not just talking about the $12 billion in repairs. And third, what this means for the future of real estate investing, not just in North Carolina, but across climate-vulnerable markets nationwide. By the end of this video, you'll understand why some of the smartest real estate professionals are calling climate change an existential threat to the industry, and what you need to know to protect your investments. Let's get into it. So let's rewind to September 2024, right before Hurricane Helene made landfall. Western North Carolina wasn't just growing, it was exploding. Here are the numbers. Between January 2020 and January 2025, home prices in 7 western North Carolina counties grew by over 70%. Let me repeat that. 70%. Counties like Avery, Transylvania, Watauga, and Macon saw their home values nearly double in just 5 years. To put that in perspective, the national home price growth during that same period? 46%. North Carolina was outpacing the entire country. But why? 3 reasons. Number 1, the Great Migration. People were flooding into Western North Carolina for the picturesque landscapes, lower cost of living, and frankly, to escape higher-cost cities. Retirees, remote workers, tourists, everyone wanted a piece of this region. Number 2, the Airbnb effect. Counties in the high country region had an outsized share of vacation homes and short-term rentals. This pulled inventory off the market for full-time residents and pushed rents and home prices sky high. When homes become investment properties instead of places to live, you get a supply crunch. Number 3, classic supply and demand. There simply wasn't enough housing being built to meet the demand. This wasn't just a North Carolina problem, but here, it was amplified by geography. You can't just build anywhere in the mountains. So by September 2024, you had a market that was tight. Housing affordability was already a major concern. Renters were spending more than 30% of their income on housing. First-time buyers were getting priced out, and then Helene hit. Hurricane Helene made landfall and changed everything. The immediate damage? Catastrophic. According to preliminary estimates from the North Carolina Office of State Budget, residential repair needs topped $12 billion, but that's just for fixing structures. Add in temporary housing, personal property damage, and disaster mitigation, and you're looking at another $3 billion. Let's zoom in on the hardest hit areas. Buncombe, Henderson, and Yancey counties reported the highest total assessed damages. But here's where it gets interesting. When you look at damage per housing unit, the narrative shifts. McDowell, Avery, and Ashe counties, which are less populated, had the highest damage per household. What does that mean? It means in these rural areas, the impact on individual families was even more severe. Communities near rivers like the Swannanoa and Lake Lure were essentially wiped out. But here's the part that should worry every homeowner and investor watching this. Many of these people didn't have flood insurance. Why? Because according to FEMA's old flood maps, they weren't in a flood zone. Let me introduce you to something called The FEMA versus reality problem. Traditional FEMA maps have been the gold standard for determining flood risk for decades, but they're outdated. New predictive tools like the First Street Foundation database integrated into Zillow are showing that properties FEMA says are safe are actually at high risk. Ashley Rummage, a Raleigh area realtor, told reporters about clients who see their homes rated at higher flood risk on Zillow while FEMA shows they're not in a floodplain. She said, and I quote, "It's confusing for consumers." Confusing? Try terrifying. Imagine buying a home, checking the FEMA map, feeling safe, and then watching floodwaters destroy everything you own. This isn't just a North Carolina problem. This is happening in Florida, Louisiana, California, and it's creeping north. The climate risk that was once abstract and distant is now knocking on everyone's door. So, where does this leave the North Carolina housing market? Well, economists will tell you the medium and long-term impact of hurricanes on housing markets is mixed. It depends on severity, geography, and how communities respond. But we can identify two possible scenarios. Scenario 1, the supply crunch worsens. After a hurricane, housing stock declines. Damaged homes come off the market. Meanwhile, displaced residents need somewhere to live, so demand for available housing spikes. Prices go up, rents go up, and people who were already struggling get squeezed even harder. This is especially likely in rural areas where mountainous terrain delays rebuilding and increases costs. Scenario 2, the market cools. Property values decline due to damage. People relocate temporarily or permanently. Demand falls, prices stabilize or drop. In Asheville, for example, year-over-year rent growth softened from 4% in October 2024 to 2% by January 2025. That suggests some displaced residents haven't returned. But here's the catch. We don't know yet which scenario will dominate. Renters are especially vulnerable. They're more mobile, which means they might leave permanently. But they also face evictions due to unemployment and underemployment after disasters. Urban counties like Buncombe, Henderson, and Madison have higher shares of renters and higher shares of residents who are housing cost-burdened. For them, this storm wasn't just a natural disaster, it was a financial catastrophe. Now, let's talk about the bigger picture, because this is where it gets really important for investors and homeowners nationwide. Craig Foley, Chief Sustainability Officer for LAER Realty Partners and a member of the National Association of Realtors Executive Committee, called climate change an existential threat to the industry. He's seeing insurance costs skyrocket in high-risk states. Major insurers are scaling back coverage in places like Florida, Louisiana, and California. And he says this is creeping north. Here's his take. Interest rates are part of the housing slowdown, but they're not the only factor. Young people, especially first-time homebuyers, are looking at these disasters and questioning whether homeownership even makes sense anymore. They're thinking, why would I invest hundreds of thousands of dollars in an asset that could be destroyed by a flood, wildfire, or hurricane in 10 years? This is a generational shift in how people think about real estate. And if you're an investor, you need to pay attention. Okay, so everything I've just told you sounds pretty doom and gloom, right? But here's the thing. With disruption comes opportunity. North Carolina is responding. The state has proposed 3 programs for HUD grant funding: rebuilding severely damaged homes, constructing homes for low and moderate income residents, and repairing rental housing stock. Cities like Raleigh and Wilmington are rewriting long-term development plans. They're integrating stormwater design, tree canopy protection, and denser housing. Instead of building out, they're building up. This is smart. It reduces sprawl, protects infrastructure, and makes communities more resilient. Ashley Rummage, The realtor I mentioned earlier says there's growing interest in resilience among buyers and developers. People are starting to pay attention. They're asking the right questions. They're looking at flood maps, insurance costs, and long-term climate projections before they buy. And here's the investment thesis. Properties that are climate resilient in walkable urban areas with strong infrastructure and low flood risk. Those are going to appreciate. Properties in high-risk zones with rising insurance costs and unclear flood risk, those are going to struggle. So if you're looking at North Carolina or any climate-vulnerable market, here's what you need to do. 1. Use multiple data sources. Don't just trust FEMA. Check First Street Foundation, talk to local stormwater divisions, and look at historical flooding patterns. 2. Factor in insurance costs. A house might look affordable until you realize flood insurance costs $5,000 a year. 3. Think long-term. Climate patterns are changing. A safe area today might not be safe in 20 years. 4. Look for resilience. Invest in communities that are adapting, not ignoring the problem. All right, that's the North Carolina housing market after Hurricane Helene. But I want to hear from you. Are you in North Carolina? Have you seen these changes firsthand? Or are you an investor looking at climate-vulnerable markets and trying to figure out your next move? Drop a comment below. Let's have a conversation. And if you found this analysis valuable, smash that like button and subscribe. I'm breaking down real estate markets, economic trends, and investment strategies every week. You don't want to miss it. Here's my final thought. Hurricane Helene didn't just destroy homes in western North Carolina, it exposed a fundamental tension in the American housing market. We're building in places that are becoming less and less habitable. We're using outdated maps to assess risk, and we're expecting people to make the biggest financial decision of their lives with incomplete information. North Carolina is the canary in the coal mine. What happens here will ripple across the country. Climate risk is real estate risk now, and the sooner we accept that, the better decisions we'll make. Thanks for watching. I'll see you in the next one.